blockchain is even, obviously, it could be a threat.
I guess a huge advantage is on the custodian service is the security element.
On the institutional side, there's no choice.
Governments want to go into crypto and have Bitcoin reserve. How do you see that evolving?
What it means in really simple terms is we print dollar to buy Bitcoins.
Hey everybody, happy to be back again. The TRUF.NETWORK is coming to life more and more, and we're going to go more deeper into lots of entrepreneurs that are building out in the crypto world. As you know, we've been doing this for a while now, and so I'm super happy to be here in Hong Kong physically with Alessio, founder and CEO of Hex Trust and Clearpool. And yeah, lots of interesting innovations that you're driving. I remember we met first time way back. Sorry, I broke my finger, so you're still going to see my finger here. Sorry about that. But yeah, we met the first time, I think it was like back in 2018 or 19 when you first just launched your business, sort of. We were at a conference together. At the time, I was still the CEO of Bitcoin.com, and you were pitching Hex Trust to a group of ultra high net worth individuals that had no idea about Bitcoin and what you're doing. So you've come a long way, and congratulations to you and that tenacity.
Yeah.
What got you into crypto? Why were you excited about this opportunity?
Oh my God, that's really a long journey.
A loaded question.
I was quite lucky, right, to meet somebody back in 2014 that explained to me the idea of Bitcoin. I was a banker back then, so I mean, skeptical to a certain degree. But this idea really, I still remember the analogy that he made. Yeah. We're having coffee in front of ICC in Civic Square, and ICC is one of the tallest buildings in Hong Kong, right? And he told me in 10, 20 years, the whole building is not going to be Morgan Stanley, Deutsche Bank, Credit Suisse. Well, actually, Credit Suisse, actually, he was right. But it's going to be all fintech companies and blockchain companies. I said, what is blockchain companies? And then we spoke about Bitcoin. I went back to the office and I looked for a way to buy my first Bitcoin. So that was my initial, let's say, gambit into the crypto world. Then I really started liking it. Even for a couple of years, probably I forgot about it because I mean, price actually draws interest, right? Then the price started moving again. Probably what was it, in the second half of 16 or 17, and I started kind of managing some money from friends and family that wanted to also buy Bitcoin. And then at the end of 2017, I said, all right, this is actually is not just a game. This is really a new asset class. And it's not every day that you're in front of a new asset class. It doesn't happen so often, right? In the financial markets, we have FX, fixed income, equities, commodities, and it's been the same for how many years? Decades, right? And now I said, okay, this is going to be a new asset class, so which means the new financial system can be built around this asset class. New service providers, new investment products, new kind of derivatives, etc. And this is quite cool. It doesn't happen every day, so I need to do something to capture this opportunity. And then that's how we started in 2018.
Amazing. And I think one of the things is it's an asset class that grew out of vaporware, right? I mean, it's a digital asset class, so it came out of nowhere. It's not physical assets from the ground that you've mined or anything, which is a unique element to it. I think, on that, when you say you were a banker, I meet a lot of people and I'm a banker. It's like, but what kind of banker are you? Because banking has such a broad set of services and skill sets, right?
Yeah.
What part of the financial services sector were you working in?
I'm one of the, I would say, the bad guys.
Yeah.
So first of all, I'm an engineer. So I'm one of those telecommunication, electronic engineers that was, let's say, captured by financial markets because obviously pay is more attractive, et cetera. So I was an engineer probably for a couple of years, and then I moved into financial markets. And when I say a bad guy, just kidding, because actually the first step into financial markets for myself was actually working for the regulator.
Okay, interesting.
So I used to work for the Italian Securities and Exchange Commission called CONSOB. And I was in the market abuse department. So basically we were going after market manipulation, insider trading, strategies, etc. And especially we have built a system to kind of detect automatically with stochastic models market manipulations between spot and derivatives markets. That was right during or after the GFC. So it was really the first time that the regulator was actually looking into the derivatives market more broadly, and they had realized, all right, we only have lawyers and economists, right, and we need actually technical people. So quant people. So they started really hiring mathematicians, engineers, etc. And I was one of the part of that batch. That didn't last too long. Fantastic experience. I think it gave me really a good perspective on how regulators think, and that's critical in the crypto world, by the way. And then I had another big, I would say, opportunity to move to Hong Kong as a banker. At the beginning for a Spanish bank, and then over the years I did strategy. I did a little bit of sales and trading, and I did basically client coverage for financial institutions, financial institution group. It's called FIG. Where basically I was covering central banks and non-bank financial institutions more broadly around Asia.
Interesting. And that sort of then led to you opening up and sort of seeing the opportunity, combining that skill set, that background into launching Hex Trust in 2018. And you, I remember when we first met, you were very much, I was very much the DeFi guy, you were very much the TradFi sort of compliant person. And you actually managed, you were tenacious and patient with working to convince other institutions to leverage and monetize on the opportunity that crypto, blockchain represents and the tokenization of assets. That must have been a really long educational journey, right, that you went through, and I know you did. So how did you find that, and how do you find it different today versus, let's say, 2020, right? I mean, we're 5 years now nearly in. How do you find that difference?
I would say probably from a strategic perspective, I was right. From a tactical perspective, I could have done better. Now, in 2017, I met this person that kind of changed my professional trajectory. My co-founder, Rafal Czerniawski. He is really a technologist, kind of guru. He built financial markets technologies for a number of investment banks. And in his last role, he was the CTO at CLSA, which is kind of the broker-dealer that revolutionized, I would say, electronic trading, settlement, especially in Asia. So we sat down. I remember, actually, we sat down in the same place where we had wine 5-6 years ago, and we were having lunch one in front of the other. I said, okay, we need to do something in the blockchain space. This is the opportunity. And we were discussing, what should we do? Should we be an exchange? Should we be a broker-dealer? Should we do custody? And that's what I'm saying. Custody strategically was actually a very good choice, but tactically, it has been extremely, extremely hard, right? For a number of reasons. Because it's a very tough service to monetize, right? Why would people hate to pay money to other people to keep your money, right? So this is not something that is very easy to monetize. And then at the same time, I think for people to trust to hold your money, you need to kind of reach a certain scale level, which as a startup is quite complex. But anyway, I still believe that custody was a very good beginning, right? And I think we can talk about why I think custody is critical for the blockchain world. But I think that gave us really the core infrastructure, built our branding, our reputation of security, of reliability. That then I would say put the foundations for Hex Trust for the point where we are now.
And just on that point, right? I mean, we hear a lot about and experience a lot about cyber activity, cyber crime, cyber hacking, criminal activity. And at the time when we first met, I was very much putting your coins on as a decentralized vault and self-custody versus a custodian service, right? And I guess a huge advantage is on the custodian service is the security element, right? You've got a whole team that invests on constantly protecting, I guess, other people's coins that are custodied by and with you, right? As well as other sort of regulatory compliance elements that you need to adhere to ensure that other people's coins are protected in the right hands. Yeah, how did I
think, well, I mean, obviously, crypto kind of gives you the freedom to do your self-custody, right? Now, this is a very important right for you to hold your coins, right? But it comes with
your keys, your coins,
your
right?
keys, your coins, etc. But it comes with a lot of responsibility, right? So holding your keys, I think if it's up to a certain level of wealth, it can be feasible. After a while, I mean, you basically end up having to build the whole security infrastructure by yourself, right? You need to start splitting the seed in different vaults and think about a process, a strategy in case something happens to you, who and when can they retrieve the seed. And if you and your wife or partner pass away at the same time, how the other people can actually retrieve the seed and rebuild the private key, but at the same time without stealing the coins for you if you're still alive. So it becomes extremely complex, right? Also to protect yourself and your family. And that's when, even as an individual, I think basically delegating the custody to somebody else. It doesn't have to be a custodian. It can be an exchange. It can be a broker-dealer kind of happens. So this, I think, on the retail pro-tail side, it's kind of a 50-50. Everybody has a freedom. But then on the institutional side, there's no choice, right? Institutions that manage third-party money, they must appoint a third-party custodian, right? Why? Because obviously you need to separate the asset management activities or the broker activities from the actual assets, right? This is the basic rule of intermediaries. And at the same time, usually these intermediaries are regulated, right? And as a regulated intermediaries, you need to work with regulated parties, right, that follow a set of rules to protect clients' assets, et cetera, et cetera. So the issue is that this kind of institutionalization and a regulatory approach to crypto took so much longer. I expected it would take a long time, especially working for the regulator. I didn't expect it would take 7 years to see the first actual regulated product, an ETF in the US, to actually happen. And even today, how many banks in the real life allow you to actually hold your Bitcoins and buy and sell, right? Very few. It's still very limited. It's happening now. I mean, I think 2024 is really the first time that we're seeing a proper distribution of digital assets to the world, but we're still probably talking about a 1 to 5% coverage of the population.
No, I mean, I think that's regulations has been a real big challenge, number one, and adoption. And I think one thing that the BlackRock ETF really changed, or the approval of an ETF, let's say just whether it's BlackRock or not, really changed the game, I think, for institutions to sort of get their head, I have to study this, right? And
or maybe those guys are not criminals anymore. If BlackRock does it, then those guys, I thought they were criminals. Actually, maybe they're not.
Yeah, it's funny because in some ways, they were telling us, oh, Bitcoin's a bad, but in the background, they were all preparing to get their ETFs ready and then launch it. Once they've now done it, they're not criminals, right? They own a large pool of funding. And we've had a big change since the election. We know that Gary Gensler stepped down from the SEC, which is the U.S. regulator, which the U.S. has played its own world in a way from the rest of the world. But how do you see that, now that that's unlocked and we're hearing governments want to go into crypto and have Bitcoin reserve. We've had Argentina, El Salvador now negotiating with the IMF to, sort of get new loans based on the Bitcoin collateral that they've managed to amass. How do you see that evolving? Do you see more sovereign wealth funds are beginning to adopt Bitcoin? So ultimately, you're prime positioned with Hex Trust, at least, to really be a standard implementation or a key central point around the ecosystem that's evolving.
Let's see about that. But if we want to summarize the evolution of crypto adoption, right? It's really, in my view, it really happens in 4 different cycles, right? So you have the cycle where probably you and I started, which was more of a, let's say, tech kind of cycle, right? Developers, etc. They were excited about this new technology, but not even about the financial applications. It was more about the tech. It was really about the technology. You made me laugh with the meme. And then there was this kind of retail phase, probably from 2016, 17 on, which was a speculative phase. Right, retail, they got excited. There was kind of a little bit of a online casino,
ICO boom.
Right? ICO boom. I mean, there are ways to make money. It's a different way of playing and make money at the same time, etc. The retail phase. Now, I would say, beginning of 2024, with the launch of the ETF, we properly started the institutional phase, where you have instruments that allow institutions to enter the space and to start benchmarking Bitcoin and other crypto assets. This is important because basically, as this becomes a real asset class, at the beginning it was part of an alternative asset basket. Now it's probably even an asset class in itself. So they will start building a portfolio allocation of 1, 2, 3, 5%. Right? And as the price of Bitcoin increases, this allocation will stabilize or increase. And then at that point, you basically have all institutions and distributions that will start benchmarking. And it will be a self-fulfilling kind of reflexive type of process in which the price will increase as they increase the benchmark, etc. Now, this phase, I think now is not yet in full steam because, how many private banks or banks are actually pushed to you Bitcoin investments? Not yet.
Not yet.
Right? They push to you dual currency accumulators, all strange derivatives, right? Or money market funds, but nobody's really pushing any Bitcoin products yet. So it's not in full steam, but we are in that phase. As I was chatting with CNBC the other day, the most interesting phase, however, is the next one, which is the sovereign phase. Which has nothing to do with the institutional. It's connected, but not really. It's basically central banks and governments starting to think about using Bitcoin as a reserve currency.
Asset,
And this is a very different kind of approach, right? Because you have, 21 million Bitcoin, probably we have 15, 16, right, actually available. And a big chunk of them, they're already taken, right, by strong, big institutions. But now we will have got 195 countries around the world that will have to compete to actually buy Bitcoins, right? An asset that is in very tight supply. And this is right, kind of really a digital rush, right? Similar to the gold rush of countries accumulating Bitcoin. And I think it's going to be extremely transformative for the whole industry.
I think that's it, right? So once one nation goes, then all of a sudden you're going to see a ripple-on effect that I need to.
Especially if it's the U.S.
When the U.S. goes, and there's this proposal that I find extremely interesting from Loomis, Senator Loomis, who put forward the idea that the U.S. is sitting on a huge gold reserve that hasn't been repriced since, I think, 1970 or something. And so it's sitting there at $40 a kilo or something, or versus the thousands that it is now. So their whole idea is to issue certificates, sell those certificates on the premium value, and then use the proceeds to then buy Bitcoin. And then the gamification that's going to start taking place associated with the ability to acquire and build out a reserve pool for nations how is that going to impact all other nations, right?
So first of all, I think, we're talking about the most powerful, wealthiest, and
the biggest
more
GDP,
structured
right?
GDP country in the world. So I'm very optimistic, but the simplicity by which Trump puts it, I think is not really going to happen. There's going to be a little bit of under delivery, right? I don't think when is the inauguration date?
20th of January.
I don't think on the 21st of January we will have a strategic reserve of Bitcoin, and revaluing the gold that has been at 40 something dollars now for 50 years to 2000. So it's not going to happen overnight. And we're not sure if it's going to happen at all. But I think something will happen. But what you mentioned is actually very interesting. What if the United States revalue their gold reserves and issue certificates against it to buy Bitcoins? What it means in really simple terms is we print dollars right, to buy Bitcoins, which means we increase the amount of dollars available to buy Bitcoin, which in other terms it means we devalue the dollar to buy a real asset, real asset, right? So what it means, since you mentioned the ripple effect, is that the whole rest of the world, they are dollarized. They're all holding US dollar debt. They're all holding US dollars everywhere around the world. So all these guys, they're going to be
devalued,
deflated away, devalued, debased by a lot. Think about, I mean, if they only revalue dollar by 10x, which is nothing. So if I was another country, and there are a few countries here in Asia holding, I mean, Japan and China right? Holding biggest a whole holders, lot of US dollars and US dollar debt, and this is going to be devalued. What am I going to do? Right? I mean, I will need to buy something else before I get diluted away by this action. So that's what can really trigger a huge demand for, well, I don't want to say Bitcoin, but at least real world assets. It can be gold, can be Bitcoin, but if you think that they will buy Bitcoin, obviously I would try to front run the US government and buy Bitcoin now rather than wait until they lower the value of dollars. Debase the value of dollars to buy Bitcoin.
One thing is, you know, I was looking at who is the biggest debt holder on US debt, right? $36 trillion. Who holds the debt? I mean, to your point, China, Japan, big holders. But the biggest holder with like 5 trillion plus is the Federal Reserve. So how does the Federal Reserve play in such, what's their role in such a decision-making process? Do you know? I mean, I'm just curious.
In the decision-making process of buying debt or buying Bitcoin? Or
just buying Bitcoin because Powell went out and said Bitcoin's a competitor to gold and not to the dollar. And I mean, ultimately,
I think that the Fed is independent, right?
It's supposed to be, right? But it's
supposed to be independent.
Can't be independent with $5.6 trillion of debt that they're sitting on.
I think it's going to be of course, I mean, that's pure monetization. I mean, I think we already, the train of independent central banks has already left.
It's gone, right?
Everything is being monetized with money that has been printed. So that's too late. So now, what can they do? What can they do? The thing is that the central bank, they have a monopoly. Of printing money. So giving up that monopoly, it's not going to be easy, right? I mean, countries that don't have a lot of monopoly, but I mean, usually they have the currency that they can print and the army. Right? Those
are the two.
So they don't allow anybody to build their own army within a country, and they don't allow anybody to print a different kind of currency within a country. Right? So those are really monopolies. So what can the central bank do? Are they going to give up the monopoly, right? Accepting a different currency? So are they going to partner up, or are they going to be an obstacle? But it doesn't necessarily have to be the central bank, right? The United States, actually, I mean, it doesn't have to be the central bank of the United States buying Bitcoin. I mean, it can be different arms.
Different arms, the different Federal Reserves they have.
Different Federal Reserves. It can be different governments, local governments issuing debt to buy Bitcoin. But in turn, it's financed by the Fed. So it's the same thing. I think for the United States, one thing that Unfortunately, I had to listen to the whole conference that Trump did. Where was it? The Bitcoin conference.
In Nashville, in Tennessee.
Nashville. I had to listen
in
to
March
the whole
or
thing
something
because I had an interview the day after. So that's okay. So, but one thing that I think is also interesting for the United States is apart from Bitcoin, is the adoption of stablecoins. Right. So at the end of the day, I like to think the crypto world is a free world, right? And people can decide whether they want to hold Bitcoin, whether they want to hold Ethereum stable coins in US dollars, in euro, right? And everybody chose to use stable coins denominated in US dollars, right? That's basically 99.9% of the pairs, trading pairs, and right, it's in US dollar. So that's a very important weapon, considering the United States, they need to print more debt, right? They need to issue more dollars. So how can they compete with other countries to basically compete with their local currencies and export the US dollars to the rest of the world? And I think that's why they're not shutting down USDT, right? They could, as Paulo said, if they really wanted, they could shut down USDT. Why are they not doing it? Because it's a fantastic sales channel for US dollars to the rest of the world.
And I think that's, and what we've seen, if crypto is anything to go by, the rest of the world does think in dollar, right? To your point, stablecoins are 99.9% all in US dollar denominated. So the currency that transcends all the borders on the internet is US dollar, right? And so, interesting. So why, but one, that sort of leads me to sort of think, we now have had a big regulatory shift. We've seen the growth in stablecoins in dollars, which actually is the tokenization of the US dollar.
Or US dollar debt.
Yeah, or US dollar debt. Yeah, no, totally, because it's backed by US dollar debt in a lot of the cases too. I think Tether has more US T-bills than Germany or something like that, right?
Kind of, I think the 8th or 9th holder of T-bills.
T-bills.
No wonder they don't shut them down. They're a sales channel.
Yeah, exactly. Yeah.
It's a best partner. Yeah, they do it for free.
And who was it? I think State Street. They work with State Street or something. And and anyway, so that's on one hand, and then we're seeing the rehypothecation of dollars and the other assets, right? And now you've also launched another product, right? So, which we haven't talked about yet, is Clearpool, right? And you're spending, it's done really well. It's taken real world assets and tried to understand loan and debt and how do we commercialize and tokenize some of that debt to connect the real world with the capabilities of DeFi. Can you share a bit about what is Clearpool, maybe a bit sort of so the audience have a bit of an understanding of that, and then where you see tokenization of real world assets? Where's that going?
So Clearpool was really born with the idea of, basically, the blockchain market, the initial idea is that everything has to be trustless. Yeah. So for those who have not really played around DeFi, basically you can trade, you can borrow, you can lend, you can leverage, but you don't know who you are actually, who your counterparty in the market is. It's just an address. It can be a smart contract address or it can be a wallet. But basically the whole philosophy behind the DeFi world is that everything is trustless. It doesn't matter whether you don't know who you're dealing with, but still, right, without any trust, because you don't know the other counterparty, you can still basically do all the financial primitives that you can do in a trusted manner in traditional finance. Now, I think this was very powerful, right? And it was something that was solved with technology, and it wouldn't have been possible in the traditional world. So a very good experiment with quite decent success. But back then I was thinking, all right, we cannot have the whole world thinking about in terms of everything being trustless. Yeah. Right? We are human beings. We need to trust something, right? You go to a party, I bring a bottle of wine. I trust that somebody else will bring a bottle of something else, right? Yeah. Otherwise,
or the glasses.
Yeah, or the glasses, right? If I cannot trust that anybody else will bring something, you will not have a party. Yeah. Right? You need this kind of basic level of trust, I would say, in human society. Yeah. So I said, okay, let's try to introduce a little bit of trust in a trustless world. Yeah. And that's basically Clearpool in a nutshell. I would say was kind of a modification of Compound, right? In Compound, you have several borrowers and several lenders, and borrowers and lenders in a pool. They don't know each other. They borrow and lend from each other. In Clearpool, you have one borrower that you know. Yep. It's a name that you know, and the credit of this counterparty is assessed by third parties. Yep. And you have multiple lenders. Yeah. So it's basically bringing not over collateralized, trustless type of lending and borrowing, but a credit risk on chain, allowing people to lend in a, I would say, trustless way, but to a counterparty that they know. In a decentralized way, to a counterparty that they know. Yeah. And this actually, I mean, when we launched the product, it was funny because we said, okay, how hard it was to actually launch Hex Trust and make a custody platform successful. This product had a, I would say, perfect product market fit. So we originated. So it was also that the time that everybody was borrowing because the market was frothy and stuff. So there was a lot of credit formation. But basically, we were very successful in creating quite a substantial amount of loans. As of today, I think we've created over $700 million of loans. So the platform was very successful. And then we did a little bit of additional iterations to improve the product, etc. And now we are at the next phase of development where Clearpool is actually turning into, from a D-app, you didn't know about this.
No, I did.
It's basically
I know
transforming into
a chain, right?
To a chain, an L2 called Ozian, Oz. And it's basically where we want to build an ecosystem where not only credit, but also other real-world assets or real assets can be brought to this chain and use some of the primitives that we have created with Clearpool and with Hex Trust.
Yeah, interesting. And so, I mean, I think one thing that if I were to sort of step back just quickly as you were talking there, I think one thing you've realized is you bet on the fact that people want to abdicate responsibility at some point, right? I don't want to be responsible for my own keys because if I lose my own keys, I have nobody to blame on the one hand. And psychologically, inherently, I think in all people, that is sort of very deep entrenched in us that we want to have somebody responsible for looking after us in a way, right? And I think you've done a good job at doing that.
Yeah, and I think, I mean, I don't want to speak for other people, but I think if somebody has been long enough in the crypto space and if somebody has played enough, I think everybody has been hacked or scammed. Yeah. It's basically impossible not to have lost any coins if you've played around blockchain for a while, right? So it makes, I would say, there's quite a number of cool things and advantages in using blockchain for cross-border payments, for investments and everything. But the responsibility of security is quite heavy.
Quite a burden, especially if the wealth grows significantly,
if your wealth
right?
grows, I mean, if you have a family, you want to protect your wealth in the same way that in traditional finance, you go to a bank and say, okay, private bank, dear private bank, I can trust you because you've been around for 500 years. All my money and make it grow, and I will pay a little bit of a fee for that. You will go to a custodian, I would say, or an intermediary, a licensed intermediary in the crypto world to do that.
So if you look at that, and then you look at where you've brought Clearpool, and now you're launching Ozian, why build a blockchain, right? You need more engineers, you need more work, you need more support, you need to build out a whole ecosystem, you need to acquire developers who are going to build on top of the chain. What was that shift? Why the shift to build an L2? Or that transition, or the evolution maybe is a better word.
Because I really believe in the blockchain as an ecosystem market, right? The beauty. So there was one point. Let me talk about this. There was one point that I realized the importance of kind of this ecosystem growth. At a certain point of development of Clearpool, I don't remember exactly when it was. So when you land on Clearpool, you receive a kind of an IOU token. Yeah. It's called CP token, right? Okay. So if I land to, I don't know, Wintermute, I get a CP Wintermute token for that pool, right? Which represents my loan position to Wintermute. Then we started realizing that there were a couple of wallets that were accumulating a lot of these CP tokens, right? And there was, it was quite concentrated, right? There was quite a bit of concentration around these wallets, and we didn't know who was lending so much to all these kind of parties, right? But then, of course, the blockchain is pseudonymous, but then after a while, you can try to understand who it is. Then we found out that there was basically another company, right, that had built a product, a credit product, on top of the CP tokens of Clearpool, basically taking these loan positions and tranching them into different tranches, right? The equity tranche, the mezzanine, etc. And then they were repackaging it, adding some stuff, senior, and then repackaging it.
Synthetic CDOs.
And offering them to their... And I mean, the cool thing is
Brilliant.
that we didn't even know about it, that somebody was doing it. In traditional finance, you need to sign thousands of pages of agreement to repackage mortgages into, right? And the process takes so long and it's not transparent. I mean, you know how it ends usually, right? This was all on chain. We could see it, and without even knowing who was doing it, right? Everything was kind of... So this concept of, on one side, legal finance, and on the other side of, if you kind of put together companies that do adjacent businesses together, we cannot, as Clearpool founders, we cannot be experts in tokenization. We cannot be experts in securitization, tranching, in building derivatives on top of credit and credit rating and all these things. What we can do is to put together experts in a network and create an ecosystem of people that work on the same network, following more or less the same rules. And this is Ocean, right? So it's an ecosystem for everybody that wants to build similar things to what we've done in Clearpool, that wants to use a trusted stablecoin that is issued by Hex Trust, that thinks that a network should actually, you should pay gas, not in a random token that you don't know the price of, but in Ocean, the fees are going to be paid in our stablecoin. So it's one of the first networks where stablecoin is used for gas fees. So you don't need to go on a DEX to buy the network token to pay for fees. And there is a compliance layer, so we can enable different layers of kind of KYC and attestation of clients to make sure that only certain products are distributed to certain individuals or corporations. So that's it, right? So you build some rules, you build kind of the backbone, and then you let companies go and build adjacent businesses to make the network value. To
add more value. And I think one of the things that really the blockchain does represent are these new financial rails that, as you just highlighted, the fact that I can build these new products at a much more efficient, from a cost basis and a time-wise as well, right? So I can bring it out into the market at a lower cost, at a much shorter time cycle.
I don't want to mention how many people when we made 700 million or whatever loans in Clearpool, right? So think about in a bank like, give me a name of a Hong Kong bank.
Bank of, I just saw, what was it? The Bank of China, the biggest bank, strongest bank in Hong Kong is the Bank of China, Hong Kong. So there you go.
Imagine.
I don't know how they're the strongest. I mean,
imagine how many people need to work in a bank to originate $100 million of loans, right? From all the credit administrations to the sales, to the back office, to the accounting, to the
client compliance, the legal, the audit. My God!
Imagine how much time it takes to issue a loan, and imagine how many people are involved and the monitoring of the loan, the servicing of the loan over time. In Clearpool, I mean, how many people do we have? I'm not going to disclose the number, but you don't need anybody. Once you build a smart contract in the right way, it just does everything by itself. So it speaks for itself how much simpler it is.
I mean, that's the beauty of the blockchain, right? I mean, really, I think that is a huge opportunity. I mean, I was talking to a bank the other day, and not the other day, the other year, I think it was, and they were spending 70 cents on the dollar. So every dollar revenue, top line that they make, 70 cents goes to compliance, processes, et cetera, et cetera. I mean, maybe it's not that high, maybe it is that high, I don't know, but that's a reference point that is out there, right? And so...
Yeah, I mean, the compliance topic is a huge topic that really excites me, coming from a
regulatory. But how inefficient is that? I mean, talking about, right now we're all about the efficiency, government efficiency, bureaucrat, and operational efficiency.
Honestly, do we really believe that asking for the certificate of incorporation of a company prevents terrorism financing? I mean, we all want to prevent money laundering. We all want to prevent terrorism financing, but that's not the way. right? Asking for the certificate of incorporation or the notarized, whatever, memorandum of association of a company doesn't prevent anything. It's just a huge burden. And guess what? Who pays for this burden?
The user.
Yeah, it's obviously, the bank, instead of paying you 4.5% on your deposits, you get
0%,
right? Because they need to prevent. But how many terrorists are out there in Hong Kong to open a bank account? So we're building this whole kind of intelligence to prevent terrorism when probably the hit ratio is so low. I think these things could be done much better, and maybe the blockchain is even. Obviously, it could be a threat, but it really can be a solution. Look at how easy it is to track funds, and how many times we were able, blockchain companies were able to actually track and lock and freeze wallets that were involved in hacks, in money laundering activities, etc. Yeah?
And I think that's the beauty. It's so transparent. I think the whole media has made this out to be this. Intransparent, dark web and everything, right? But actually, to your point now, I can follow all the transactions. I can find the wallets. I can see the movement of money. And mostly, we can also track who owns the wallets nowadays, right? It's now become so vastly exposed. Obviously, you can create new ones each time, but you know where the funds are coming from. So all of that movement is available for people to track and monitor, right? And so that's...
Maybe on the negative side, also
play devil's advocate.
Play the devil's advocate. I think in the blockchain world, we could have done much better in terms of actually working on solutions and things that could be useful to work together with the status quo, with the existing financial. Because obviously everybody's building a new blockchain protocol. Everybody's launching a new DApp. Because there's an upside in terms of issuing tokens. So everybody is basically doing where the money is going, right? Yeah. So VCs, they want to invest in new tokens, right? So everybody's building new tokens. But actually, how simple would it be to start really, if all the money that are being thrown at new blockchain protocols that have zero transactions, right? If a portion of those funds were thrown at really building on-chain identity, right? Yeah. Being able to link wallets to real identity of people, right? That wouldn't be so hard. Right, across different chains, right, and creating some kind of decentralized registries where you can actually really monitor activities and transactions and implement a real travel rule in a scalable way, not like it's been done right now. And that would make the blockchain even more powerful.
But I don't think that will work, right? Just purely because of jurisdictions. Look at Europe. Europe can't even get agreements between the different countries in Europe. So I just don't think it's going to work. And any time we try to work, we've been working with law enforcement, from Swiss police, cybercrime police, to the FBI, through to all different nations. And there's no way, even if you've tracked funds and you want to close down funds, it's really hard to actually go into a jurisdiction that's not from the nation's law enforcement office to then try and enforce some sort of act. It's really hard to do, and until we have a transcending sort of jurisdictional framework, it's going to be really hard to do anything.
But the blockchain gives you at least the global technological layer, right, which is already something. Because when I used to work for the regulator, I can tell you that we were doing enforcements across different jurisdictions, right? If there was a market abuse activity in Italy and it was an intermediary from the UK, then we had to send a notification to the UK regulator. And they had, I don't remember, if 3-6 months to respond. And then if the intermediary was actually somebody that was trading on behalf of somebody else in the US, then they had to send another notification. So basically, to do any enforcement, it would take years.
5 years, exactly.
Right. So I think the blockchain can actually really simplify,
accelerate that.
And I don't think we've been able really to at least show feasible solutions to governments and regulators to make them aware that actually it is possible to do things in a better way.
But on a slightly more positive note and opportunistic note, right? I mean, one of the big narratives in the blockchain right now is RWA, right? Real world assets, not risk-weighted assets, but the real world, right? The tokenization of real world. You've been working in crypto for a long time. You've evangelized and tried to educate the real world about the opportunities that the blockchain represents. And how do you see real world assets? Do you think that's going to move fast? Are we still in the experimentation phase? And we've seen it come up in loans, right? So I'm trading loans, if that's a category of real world assets. Yeah. How do you see this evolving?
I think maybe two comments on this. Yeah. The first one is really on the on what makes this really having a lot of potential. So I think blockchain has a lot of potential when you put it together with traditional businesses and finance. Yeah. Right. So if you look at the most successful stories, Bitcoin, right, by itself, yes, fantastic. Yeah. But if you put it together with an ETF, yeah, right, which is traditional finance, right? Let's not forget about it.
Yeah, totally, 100%.
Putting it, it's a wrapper, right? A traditional, then it's going to be a super successful story. Yeah. Stablecoins, there's not much crypto. There's a little bit of technology, but they're basically a tokenized asset of US dollars or US dollar so debt. You're putting together kind of the who's holding this US dollar debt or US dollar? It's banks, right? So it's putting together banks or custodians and traditional custodians with the blockchain world, and all of a sudden you have the second largest use case for blockchain technology, which is stablecoin, right, after Bitcoin. Yeah. So when you put these two things together, it actually works out very well. So I think that's the idea of, all right, let's work on RWAs. Yeah. Let's work on real businesses, not just something that's generated out of thin air, and let's put it on chain. Yeah. Now, on the second comment is about what can be tokenized. Yeah. What does it make sense to tokenize? And on this, I'm quite not skeptical, but a little bit adamant in what I believe, meaning that I think it makes no sense to tokenize on chain stuff that is actually
already real and real working. Yeah. Good
if
point.
You tokenize something on chain that actually doesn't really give you the ultimate right. Yeah. So if you hold the Bitcoin in your wallet, it's really your ultimate right to hold Bitcoin. I'm holding it, right? Yeah. And more or less even a stable coin. Yes, okay, your wallet could be frozen, but you have a very high degree of conviction that you will be able to spend those US dollars. Now, if I tokenize a building, if I tokenize my apartment, right, and then somebody steals my coins, the apartment is still there. I'm pretty sure I will not allow somebody to get that has stolen my coins, right, to sleep in my apartment. Yeah. Right. So unless we go one level below and we really tokenize the real estate registry in every single country. So to create RWAs, we need native issuance of assets on chain. Yeah. We don't need to take assets that already exist, they have their own registry, and then we write a representation of that registry on chain. Yeah. So in that case, you have two different registries, the one on chain and the real registry, the ultimate. Yeah. But this ultimate is stronger than the on-chain one. This has really little value. Yeah. So to have real-world assets, we will need government, corporates to issue their debt on chain. We will need loans to be directly originated on chain. Yeah. Not only financial assets, but even maybe real estate registries, right? To be really issued natively on chain. So certain things, financial assets that are already digital, it's kind of easier, and that's why it's fantastic that we have some already tokenization of debt on chain. Other things, real estate, etc., it will take
longer, much longer.
But we're talking about much longer. Yeah, I don't think you and I
we'll see
it in our lives.
But we want to see that.
No, just kidding. But it'll take a very long time. Yeah.
No, I totally echo that, right? I mean, I think you look at today and two things, right? One is we already have a real big financial services industry that already has inherent products and services around that, and it's very entrenched. Yeah. So you have that side, and then on the flip side, anything we need to do has to be 10x better, right? If it's not 10x better, why would I change, right? It's just not worth it. Yeah. So you have that on the one hand, and then on the other hand, to your point, I need the ecosystem to move across into that. How big is that journey? How long is that going to take? Till the land registry, I got to get a government to convince them to use a blockchain. Which blockchain do they need to use? They need a committee for the committee to understand which one to go for, to then select, etc., etc.
Then you need to explain it to your grandma.
Yeah, right? Exactly, and then it has to be usable for everybody. And so in that case, I think it's going to be much more synthetic assets, right? Loans and elements that are tradable, that actually where I can create a 10x improvement from a cost basis, a faster time to market, and things like that. And so that's exactly sort of where the real RWA opportunity lies. I think, just on that note, I think we've covered a huge range of topics, and true entrepreneur, not only building out Hex Trust and then Clearpool, but also a layer 2 Ocean. So
and one more is coming.
Another one is coming. Can we hear that?
We can close it on that on that note. It's basically something that we started doing when we were on Clearpool. I think the credit rating in a trustless plus trusted world, the credit rating and the monitoring of this credit and assessment of counterparties is going to be very important. We know that there's a big issue in the traditional world. You have 2-3 entities, right, that basically manage
all. So like the Moody's and
and we've seen what happens, right, when these people actually get paid to issue ratings. So what we're doing, we're trying to really make it decentralized,
standardized,
right? Decentralized credit rating, and the team is working on it. It's a fantastic product that is emerging. It's called Synnax.ai.
Okay.
And the product is already live.
How do you spell that? Synnax?
Synnax.
Synnax. Okay.
Synnax,
okay. Synnax. Cool.
The product is already in beta, and I think it's going to probably not as sexy as the next protocol, but I think it's going to be something extremely useful
and valuable
for the whole ecosystem.
Yeah, because we've done a lot of work in stablecoins. We launched Nuon. We've got Nuon V2 coming out on January 20th. That's why I know that exact date. But ultimately, what is with that? There are a number of entities that have been trying to rate the stablecoins, right? Give it a rating and stuff like that. So there is an inherent need to create level of trust and try to buy that trust by having a rating agency independently value.
It's not only obviously stablecoin issuers is a fundamental thing, but I mean, think about also obviously all the centralized intermediaries, exchanges, etc. But also smart contracts or staking platforms. We were talking before we turned on the cameras about are you going to stake your bitcoins? I mean, this obviously when people pay you additional returns, usually there's additional risk, right? So this risk has to be measured, right? And we need ways to measure it as a snapshot and to monitor it in real time.
Yeah, so one thing, I will check out Synnax, and I think there is a significant value there. And given the Ocean blockchain is focused on RWAs, what we'd love to do is explore an opportunity where the TRUF network can connect and provide all of the data that we aggregate at the TRUF network to the Ocean community and the developers that are going to build on there.
Sure.
And explore that opportunity. So thank you very much for your time.
Thank you so much. It's been amazing.
Yeah, really good. Good fun.
Chat.
Good catching up again.
Okay.
Thank you.
Fantastic.